we started this because we're getting so many questions from our clients, and we think it's a good time to maybe sit down and hash it out. So Summer, can you tell me a little bit about who you are and what you do?
Absolutely. Thank you for having me here today, Kaelin. My name is Summer Tatangelo. I am a financial advisor. I work in Campbell is where my office is located, but also help clients in Santa Cruz County. And basically the primary things that we do with our clients are help them kind of have a better understanding of their financial position today through financial planning, and then also helping them achieve their goals later on. So retirement planning, education planning, large purchase planning, like in the form of home, et cetera, et cetera. So we really just kind of help people, like I said, have a better understanding of their financial position and then how to reach their goals.
Right, right. And so I'm a real estate agent here in Santa Cruz County. And the reason we wanted to sit down today is because there have been some changes in both the real estate market and, the market as a whole. And so we wanted to talk about our perspectives, what we're seeing happening, why we think that's happening, and how it's affecting our strategy moving forward. So now that we've given a little bit of time for everybody to hop on in here, let's get started. So Summer, tell me a little bit about, some concerns that your clients are having and how you're helping them navigate through that.
Yeah, so I think a lot of people right now are looking at their portfolio balances and seeing that they're down dramatically, and that's obviously creating a lot of concern. And if you jump forward, Kaelin, to my first slide, there are numerous reasons why we are in the market environment that we're in today. And we kind of work through all of this with our clients. We try and educate them on why we are where we are today and try and basically convince them to stay invested. So if we jump ahead to the slide that talks about inflation. So that's one of the main reasons why we are in the situation we're in today. As everybody knows, it's headline news. Inflation is rampant right now. The Fed is trying to bring it down, and we think they are doing so successfully, but that has had a huge negative impact on the stock market. Inflation really kind of coming from the war in Ukraine is a huge element of that. The COVID stimulus money was a huge part of that. And then so there's just numerous things going on that are creating inflation issues. So that's number one reason why we're where we're at today. And if you could just back up a couple more slides, Kaelin.
Sorry, I think I was
right here. That's okay. And then increasing interest rates, which I know is really impacting the stock market, but then we'll touch base later on how that's impacting real estate, because I know that's a really big deal with real estate right now. But increasing interest rates are definitely having a negative drag on the stock market, especially when it comes to high growth stocks, like a lot of what we see here in the Valley, the Apples, the Googles, the Teslas. A lot of the stock prices are really priced based on future earnings. And so if you have to account for higher interest rates for borrowing, it brings the stock price down. So we're seeing a lot of that as well. And then frankly, we're really just in a major shift in market cycles, which is just a part of investing, right? So the market kind of moves in cycles, and they go up and they go down. And so we're really kind of shifting to, we've had a decade of immense growth and shifting more to not necessarily a negative growth, because we're not really seeing that, but just a decrease in growth. So the concerns around portfolios are valid, but we kind of understand why we're here, and like to focus on, okay, well, we're here today, so what do we do about it, and how do we move forward? And with that being said, we kind of have long-term versus short-term strategies. So what we tell our clients who are concerned about short-term, and a lot of short-term is really the primary thing that we see are people that save for a house. So they have a down payment and they're planning on buying in the next 2 years or so. So I would say for people with the short-term goals, you probably don't want to be in the market. It's not really a good place to be. And this year is a perfect example of why. If somebody had invested their down payment in the market, they would be down roughly 20%, which is huge when you're trying to buy a house, and that can really impact how much you're able to purchase. So I would say short term, we don't really want to be in the market, but for our long-term investors, what do we do about it? Well, frankly, not a whole lot, unless there's a material reason to change, like there's a reason why a particular sector might not be performing well, or there's a particular country that maybe we should or should not be invested in for whatever reason. Russia is a good example. Probably don't really want to be invested in Russia if you can avoid it. But really material changes as far as a market downturn is concerned, we don't really do a whole lot. We're not super reactionary because, again, we go back to the cyclical nature of the market, and we understand that at some point this will reverse. And nobody knows the top of the market and nobody knows the bottom until it's hindsight, until you're looking back. And so just trying to avoid timing the market, we say, hey, if you're a long-term investor, which is really anything 3 years plus, ride it out. And it'll ultimately, barring some catastrophic event, it'll work out for you in the long run.
Right. And, we'll touch on this later too, but everybody says investing is a long game more than it's a short game.
Right.
And what we've seen in the most recent years is people seeing a huge appreciation in their values in such a short amount of time. So maybe people were getting comfortable with that without realizing that's not a healthy market, right? That's not really how it goes or what you should expect. And for clients that are coming to you, I mean, are people concerned they want to pull their money out of stocks right now? And is there a benefit to be invested now rather than a couple of years ago? What are some pros and cons?
Yeah, so I would definitely say that people approach us often about taking their money out of the market. And we just kind of continue to stay grounded in the data. It's really, really easy to get caught up in the emotion of looking at a portfolio and seeing a staggering loss. And so people, they'll see that and say, I need to do whatever I can to protect myself from losing more. But what we like to remind people is until you sell, you actually haven't realized a loss. It's technically unrealized. So you've lost it on paper. If you actually hit the sale button, now you've realized a loss. So that's a little bit different. What we really do with our clients right now in these moments is just coach them, stay grounded in the data. We're regularly on the phone with analysts from numerous companies, just gathering data about where do you think we're headed? Where do you think we're going? And, we haven't, at least to this point, felt like we've seen anything that would indicate run to cash or get out of the market. In terms of new money invested today, definitely, I mean, without a doubt, stocks are on sale. I mean, if you had bought on January 3rd, which was when the market started to go down, you would be buying stocks at 20% higher than they are today. And some companies even more than that. Some of the tech companies here in the Valley are down 50% year to date. So depending on how you look at it, you could look at it and say, oh, this is terrifying. I don't want to be involved. I want to get out. Or you could look at it and you could say, wow, I can buy that really amazing, strong company that we know will be here a decade from now at a 50% discount. So it just kind of depends on your outlook. And we try and coach our clients to kind of understand, yes, we get that there's a fear and it's unfortunate that the account balances are down, but how can you really monopolize on this and make a good situation out of something that isn't so great?
And, we hear I was hearing all the time previous years, things are so inflated. You don't want to purchase now. It's so inflated. And it's like, now's the time.
Right. Yeah. And I know in housing that was huge too, especially where we live. And I know when we were working with you, that was something that we experienced. And that you're right. It was a lot of people saying, hey, look, this stock market, this housing market, it seems to just have a never ending ride up and up and up and up. And how could this possibly be sustainable? And a lot of people agree with that sentiment. And then when they see it come down, which really is a healthy, natural thing, there's this kind of reaction to, I don't like that, but it really is, in a natural, healthy market it happens. And so this market cycle slide is really good. And the reason that I include this, and I show this to a lot of my clients to really give them an understanding that market cycles have been existing since the stock market started. And so you can go back and you can see the Great Depression, World War II. You can see the tech boom. So the tech boom here in the 2000s, you can see COVID, the housing bubble. And if you look at the chart, you see, this is the Dow Jones. So it starts down at 2000. And over time, you see it like up to 1929, there's a peak, and then we hit a trough, and then we recover. And so over time, the whole point of this chart is to really see, where does the chart start and where does the chart end? Where are we today? And while there's a lot of ups and downs in between, the idea is that if you were to stay invested this whole time, even through the downturns, look at where you would be today. So I like to keep this just kind of for a long-term perspective, because when you're in these moments that are seemingly, it seems like the market is just falling, it's not going to, it just almost doesn't seem like it's going to recover. Every day there's more news and gas prices are expensive and we're kind of in it. You realize, hey, there's been all kinds of other events in history where this has happened. And again, look where we are today.
And so with folks that are thinking that the market is extremely volatile or unstable, from your experience, is this more of like a cycle that we go through and this is kind of repetitive in a sense? And as far as people reaching their long-term goals, they should just see the overall trend rather than what may be happening in this exact moment?
Exactly. Yeah. So not every market cycle is the same, and all the cycles, the peaks and troughs don't all occur for the same reasons. For example, in March of 2020, during COVID, that was completely, I wouldn't say fully unprecedented, but for our lifetime, unprecedented event where the market just went into a basically tanked 20% bear market within a month. We weren't expecting that to happen. And so that was different, right? So COVID is a different reason for a market drop than World War II. So there's different things that go on, but inevitably, yes, the cycles always kind of build up to a peak and then they trough and then peak and then a trough. And so, yes, in general, although these happen for different reasons, it really is kind of, like you said, more cyclical and something that really can be anticipated over time. We just don't know exactly in what years things will shift, right? Until it's hindsight. And then this is one of my favorite slides, and people ask me, and our clients come to us and they say, hey, we're down 20% or whatever the percentage might be. The market's down huge. Why didn't we get out at the top? Why didn't we get out at the peak? And this is a very common question. And the first answer to that is you can't time the market. If people tell you you can, they're lying to you. It's just impossible. There's just too many things at play for anybody to know with certainty that January 3rd, 2022 was the peak. And that, have we already seen the bottom? People are thinking maybe we have. It's hard to say. But we also don't know where the bottom is, right? So with the reason that we don't pull out and get back in at different times, and the reason why we stay fully invested over the long term, is exactly illustrated in this chart. A lot of times your biggest losing days in the stock market are followed by the very next day by the very best day in return. So you can have a market that's down on a Thursday 5%, and then on a Friday it's up 7%. So a lot of times we see this back to back. So if people get fearful on a really negative day and they get out, then the next day they're missing the recovery. And that's really clearly shown here. So even if you missed 5 of the best days between 1994 and 2013, your funds have been reduced by about $200,000 in gains just from missing 5 days, and so on and so forth, right? So this chart really exemplifies why we always insist, even during downturns, that it's really, really, really important to stay invested.
Right. So thank you. This is all so incredibly informative. So maybe now we could transition a little bit into real estate and what I'm seeing on my end.
Yeah. And a question for you there, because I keep hearing all over the news about a housing bust and the bottom falling out, and that there's just going to be this huge meltdown in the real estate market. And I'm kind of curious what you're seeing and what your thoughts are on that.
Yeah. So, I really like to bring it back to what I'm seeing in the field and the statistics, right? Let's look at the numbers and see what it actually translates to. And I'll tell you, I have had an increase of buyer inquiries, setting up consultations, having conversations like this. And I really like to bring up, yes, of course, the media has a whole lot to say. A lot of it is national or all of statewide, definitely not micro to Santa Cruz County, which we are definitely our own market for a number of reasons, considering our location, proximity to the beach, the redwoods, what there is to do here, the beauty, as well as our proximity to Silicon Valley, et cetera. So we've always had a really strong buyer pool. And I like to bring up too, people are, crossing their fingers as buyers for, what happened in our housing bubble.
Right.
But I like to bring up, our housing bubble was manufactured. It was created by people doing things that were slimy and fraudulent and created a very, very unstable and fake market when people were in houses that they truly could not afford because of some really shady things that were happening to consumers. So that's not the case now, especially because people are in homes that they absolutely can't afford because they've been so highly vetted. We were recently in a home search together, very well. The lenders ask for a lot of information now.
Yes.
That something like that cannot happen. So usually I like to touch on the fact that this is not at all what we were seeing then. And to your point previously, there are cycles in the market, real estate included, right? Where we go up and then it kind of levels out. And I have a slide in here that kind of shows the trend of our median sale price over time, the general trend of appreciation. And so, when I meet with people and talk about, okay, I know what you're hearing, so let's look at the numbers and let's see what we're seeing. As you can see here, since January, we even rose a little bit. I mean, just a few months ago, we were seeing 10 plus offers on a house, and it was a highly competitive situation. We weren't even able to, if we were representing buyers, get contingencies for our buyers. People were having to write no non-contingent offers. It was highly unhealthy and very, very competitive.
I remember.
Yeah, right.
Yeah, it made me very uncomfortable. I was like, this seems crazy that you would buy a home and not even have it inspected first or appraised. So I would agree that is very unhealthy.
Right. And so I'm going to bring up our appreciation trend as well, which is, was unstable. It couldn't continue. And so as you can see, though, I just want to point out, even last month, so we already had our mortgage rate increase, which was dramatic, huge, because our interest rates were so staggeringly low for so long. The only tool that the Fed had to kind of curb that inflation that you were talking about earlier, the only tool was to raise the interest rate, which, I'm sorry, folks, it was bound to happen, and it's going to continue to happen until our inflation is curbed, which is what we want. We don't want a bunch of inflation. That's not healthy either. But I just bring up, hey, we're still appreciating, right? We're just not appreciating at the astronomical levels. And so I just like to show this chart over here as well for at least the year as to where our trend is. So are we dropping? It doesn't seem that way, but I'm not going to say that there aren't indicators that are coming up. So I'm going to bring those up now. Oh, so this is the appreciation year over year for each month so far this year. And so if you look at the percentage increase from 2021, do you see 43% in March? That is outrageous.
Yeah.
Outrageous. So, what we were talking about earlier about, people saying, oh, the prices are too inflated. I don't want to get in the market when it's this inflated. Well, now we're starting to level off a little bit. Now we're not seeing those dramatic increases. Does that mean that, housing prices are dropping or housing prices are going to dramatically drop? That's not what that means. It just means we're kind of going to an equilibrium. So I also just like to point out the condo and townhome prices as well, because they're different than standalone homes. And then this is the days to sell, right? Because we're looking at those indicators that kind of point to changes in the market, right? So we want to look at sale price, list price to sale price ratio, which shows, right, if you're getting multiple offers and going over, or if you're generally going under, median days to sell, right? How long does it take to sell a home? And then you also want to look at things like the number of price reductions and the number of homes that didn't sell. And I'm getting to those soon. But as you can see, still under 2 weeks in order to sell a home. That's incredibly quick, right? Like homes are selling fast.
Right. And have you noticed a difference? It's been a seller's market for ages. Have you feel like that shifted a little bit, or do you feel like it's still a seller's market? Is it, you said equilibrium, maybe it's 50-50. How does that look today?
Not at all. It's not 50-50 at all because our inventory is still incredibly low. That being said, that doesn't change that strategy and negotiation is beginning to shift, right? So I would say now when you are a buyer in the market, if a home is priced right, sure, we'll probably see multiple offers, but it's not 10 plus that we were seeing before.
Yeah.
Maybe it's 3, right? And so that type of strategy and negotiation is not as cutthroat, right? And
Mhm.
so now I'm seeing also opportunities to get into a property when you're not competing against somebody else, which is a whole different playing field, right? We're able to get in contingencies, number one. Number two, more creative offers. Number three, those that don't necessarily have 40% down or all cash, you know, we're having a little bit more creative of offers. And I think it's making it a lot more breathable for buyers, right? And so how I'm advising sellers as well is, hey, we got to do everything right. You know, it's no more just throw the home on the market. We've got to make sure if there are issues, we got to take care of them and make sure that we do, which I've always done, but make sure our inspections are completed. So it kind of limits that renegotiation down the line. But aside from that, one of the biggest things that's a shift in how I'm doing my job as a listing agent is making sure I am vetting all of the buyers that are making an offer on the property. And the reason is because we're experiencing so many interest rate hikes. You know, we did a video recently with a local lender about what we're expecting, right? The interest rate is going to continue to raise. It is happening. So that means buyers' purchasing power is continuing to change, right? And so when I'm vetting a buyer that's writing on a listing that I have, I want to speak to that lender and make sure that they are fully qualified for this house so that if an interest rate hike happens, that's not going to affect their affordability of the house that they're purchasing because this is happening in real time. Things can shift really quickly. So I also like to point out over here, as I'm just kind of talking about the statistics of the real estate market here, you know, we're still experiencing multiple offers. Things are still selling for above listed price, at least currently. And then this is the condo townhome, also similar, still selling above. Now, here's where it gets interesting, right? So these are price reductions since the beginning of the year, right? So you'll see it was not very common at the beginning of the year. And then in June, there were 91 price reductions. And I can tell you from my standpoint, as I get emails from other agents promoting their listings, I am getting a lot more price reduction emails. And it's pretty dramatic that we're starting to see this because it was 15 price reductions is pretty low. That's pretty darn low. And to jump so dramatically to 91, that's something that you want to watch for sure.
So a question that I think, and you know, it's similar to the stock market, a question that I might think a person who recently purchased, say somebody purchased a home in the last year, and now you're saying, hey, prices are coming down. Those buyers might feel like, man, I really got in at the peak. I got in at a bad time. What would you say to them?
Well, first of all, I would say prices are not coming down here, right? So people were pricing at a point where they had to reduce, sure. But if you look at our median sale price, our prices are not, at least dramatically, they're not coming down. However, in different areas of our county, sure, they're being affected differently. This is the county as a whole, right? And I would say, again, this is a long game. If you're investing in your home, your primary residence, as you know, a short-term investment, that's not wise. That's not wise. You should not be investing in the actual house that you're going to be living in for a short-term goal. Real estate is not a short-term investment. And if you look, you know, at our appreciation, what we were seeing month over month, 20 plus appreciation. That is not standard. That was not standard. It was happening, but it had to stop. And so that short-term goal is not what you should be looking for ultimately, is what I would be telling them. You should be thinking about the long-term goal. So let me try and find the slide of, so again, this is expired, canceled, and withdrawn. So those are another indicator as well, where we like to look, okay, so what is the market rejecting? We're not seeing an incredible jump, but we're starting to see a little bit of an increase. In June, just for the record, we call it June gloom. There is usually some increase in expired, simply because school's out, people are going on vacation, the focus isn't necessarily on real estate at that time. So sometimes it gets a little gloomy. And then I like to bring up months of inventory just kind of as a perspective. And I did this year over year to see if maybe there is a change, only because June is a very interesting month, and many times we see a little bit of a change in June anyway. But you can see there's over a month more of inventory than there was last year. So in my mind, with such a low inventory, that's actually a pretty big increase. So you were asking earlier, previously it was a seller's market. Are you seeing more of a neutral market? What are you seeing? So when I look at months of inventory, a neutral market is 5 months. So we're not near there, but we are seeing a slight increase in inventory. And then I just like to point to Santa Clara County as well, because we're so close, and they tend to be about 8 months or 6 months ahead of us in terms of trends. And so as of right now, again, strong market down there, low inventory, but we are seeing an increase in price reductions and an increase in expired, canceled, and withdrawns. And those two are indicators for myself to kind of watch what's happening in the market. And so then this is when you were asking about clients that are like, hey, we bought and we're worried that the value is going down. Again, this is a long game. This is the trend since 1990. This is from all the way back from 1990. And you can see the appreciation is up. So if you were planning on selling in a couple of years, for your single family residence that you're living in, probably not a wise idea. And then I also like to point out too, because we've had this dramatic change in interest rates, this is still a very, very good interest rate as well.
Right.
And I just like to point out money is still pretty darn cheap, at least considering, where we were at previously. So I like to point to that as well. And I feel like
it's good to put things into, it's just good to put things into perspective. Because again, it's, the market's down or interest rates are rising and it's not what we're used to, but it's also not the doom and gloom that the media likes to portray, that the economy is just going to collapse and it's the end of the world. It's simply not. It's just, that's what they have to do to get views on their channel or clicks on their articles. But at the end of the day, like you said, this is very normal. And we'll get on the other end. And then for those of us that kind of wrote it out and just kind of continued life as normal, it'll really pay off in the long run.
Right, exactly. And, this is my last slide. And I think that's a good way to kind of bring it all in is, with clients that are wondering, like, where do we go from here? What would you advise them? And, is there anything you want to add to that? I feel like your last comment was pretty perfect.
Oh, well, thank you. Yeah, I just kind of like to reiterate that we can't time the market. And so I wouldn't necessarily, and you show that really well here, right, as well, that we really just kind of have to do what's best for us moving forward. So kind of move forward with your life. If you're ready to purchase a home, proceed with purchasing a home. If it's a long-term investment, it really doesn't matter whether you buy it today or you bought it a year ago. 30 years from now, that 1 year difference is going to be irrelevant. And the same is true of the stock market. If you've never invested or you're new to investing and you're not sure what to do, this is an excellent time. Stocks are on sale. But at the end of the day, whether you invest today or you invested 6 months ago or you invest 6 months from now, if you're a long-term investor, it's all irrelevant. We'll look back on this someday and it'll just be a piece of history on a chart. And we'll look at it and we'll say, hey, look at that downturn in 2022. And then we recovered some exponential amount. And just one last note on that is bear markets, which is essentially what we're in now, tend to be far shorter in time and also less on the downside than bull markets. So bear markets tend to be maybe a year, maybe two, sometimes a couple quarters. Our most recent bull market was a decade. So just keep in mind that although accounts might be down 20% now, they're up 50% since the end of COVID. So it's all perspective. And just don't get stuck in the negative and the scariness of the change. Just kind of, like I said, move forward with your plans, buy the house, invest in the market, and just don't feed into the fear, because really investing for your future, whether it's in a home or in the stock market, are really two of the best pathways to having financial freedom. And, being able to retire and send your kids to school and all of those things that most of us desire to do. So I would leave it at that. Any last comments from you?
Yeah, I would say the same thing, with buyers, with interest rates changing, it really comes down to what's affordable to you, which was the same before, right? If you find a house that is affordable to you, that meets your goals, that is the lifestyle that you want, then make the purchase, right? And it's appreciation over a very long term. And, I just like to bring it into perspective for people as well, because unfortunately right now it's the buyers that are taking the hit because they have this interest rate hike right now. But as you were saying, let's focus on the future and the long-term goals, because if you get sidetracked by the short term, you could be missing out on a huge opportunity because you're not thinking of the long term. But that's what we're here for. We're here to bring this all into perspective for people. Yes. So if someone would like to talk to you about their goals and their investment strategies, we're going to go ahead and send your contact information out so people can connect with you directly. But Summer, I can't tell you how much I appreciate it. This was all so informational and really helpful. So thank you so much for being with us here today.
Yeah, and thank you, Kaelin. Same to you. Great info.
All right. Talk soon, okay?
Okay. Thanks, everybody. Bye.